Hey everyone, welcome back to the Nadlan Forum Podcast Daily, your daily hit of real estate, mortgages, and market tea. I'm Ruby Sturt, joined by my always impressive, oddly caffeinated co-host Lior. Today we're talking about a policy move that's actually shaking up the rental housing scene, FHA's massive cut to multifamily mortgage insurance premiums. Lior, did you ever think we'd see MIP go down to just 25 basis points? That's like a quarter of what some folks used to pay?
It's wild, right? You know, Ruby, for a long time, the premiums could reach up to 95 basis points. And if I remember right, last time they did a serious change was back in 2016. Since then, costs just went up, especially for anything not qualifying for special deals or incentives. Now they say starting October 2025, all multifamily programs drop to 25 basis points flat. It's huge, especially when you look at just how few of these loans actually got used for the regular market, not just affordable or green projects. Like, it was a real choke point.
Yeah, and no one likes a choke point when you're trying to build homes, huh? Actually reminds me, Lior, you told me about a developer friend in New York last year, right? Who pretty much gave up on their project because premiums were so bonkers.
Yeah, that's exactly it. 2024. The guy shelved a multifamily plan for Brooklyn because when he ran the numbers, with the old MIP rates, it just didn't make sense. The cash flow wasn't there, especially with construction costs where they were. So he put it on ice. But after this announcement, and the projected new rates, I talked to him again, and he's already dusting off the plans. That small change in premium literally flips projects from impossible to maybe, worth another look. It could unlock a lot of that kind of pent-up development.
It's honestly kind of wild how a tweak to an insurance line item can actually change the entire tone of the market, and frankly, people's lives. Like, it gets pretty nerdy, but it matters. And it's not just about New York. These changes could be felt all over the country wherever rental projects were too expensive to pencil in. All right, so now that we've got the premium history and the new headline number sorted, let's get messy and talk about why those economics got so tough in the first place.
So, construction costs. If you're anywhere near the building space, you felt it, right? Since early 2023, material prices, lumber, concrete, you name it, they just kept climbing. The National Association of Home Builders, they were tracking it, and by late 2025, it was the highest material cost spike since January 2023. That, plus high rates, basically turned the screws on developers. Even if you wanted to build, you couldn't make the numbers work. A lot of projects got delayed or scrapped entirely. It was brutal.
It's not even just the builders, right? Renters, investors, anyone on the sidelines watching this. Suddenly rental options are getting thinner, prices are up, and everyone looks at developers like, yo, where's my affordable flat? It's not so simple. Actually, audience DM time. Someone wrote in asking, will this premium cut actually be enough to tip the scales? Or do construction costs still make things a total uphill battle? And, Lior, what do you reckon? Will lower MIP finally tempt investors back? Or is the cost monster still too big?
Ruby, that's the question. The lower premiums are definitely going to help. Maybe a lot. The big but, though, is material and labor costs. If those keep climbing, or even just don't drop much, you still have a challenge. What I think is interesting is, the timing of this. President Trump's memo in early 2025 actually told agencies like HUD to get creative, delivering emergency relief for Americans. And that meant housing too. So this isn't random. It's like a coordinated push to remove at least one major barrier for builders. But yeah, it's not a silver bullet. Some investors are going to jump back in now, because their financing just got cheaper. But until costs stabilize or rents catch up, not every deal will go green-lighted overnight. It's a real balancing act.
Yeah, and balance isn't exactly what the market's famous for, especially lately. It does make me wonder, is this the kind of nudge that at least gets some ball rolling? Or do we see even more creative incentives next? I mean, we've covered in past episodes, the market tends to need like 2 or 3 things to line up before everyone jumps.
Absolutely. Builders pay attention to these moves, and the policy change sends a message. The government wants to see more rental stock. But as we've said before, it takes more than just policy tweaks. Market conditions matter, and so do investor nerves. The next few months should show us if developers step back in or wait for more signs.
And speaking of signals, let's zoom out and talk about the bigger impact here, not just for developers, but for renters and the whole market ecosystem. So here's the big motivation behind the MIP reduction. The US just needs more rental homes, especially affordable ones. Listen, the stats are wild. HUD data showed that recently, only about 4% of the eligible loans actually went to standard market rate projects. That's insanely low, showing people basically weren't using these FHA loans except for very specific subsidized projects. It's a sign those high premiums shut out a lot of builders from even trying.
Exactly. And the hope is lowering that cost levels the playing field. It's not only affordable housing developments that benefit. Now regular market rate projects might actually make sense too. And last week I spoke with a developer out in Phoenix. He told me point blank, he'd shelved 2 separate expansion projects before. Just couldn't get the financing right. As soon as the FHA premium news hit, he said he's back at the table, crunching numbers again. That's big because Phoenix, like a lot of fast-growing cities, sees massive rental demand but hasn't been able to keep up, especially not on the affordable end.
And then you've got all the regional quirks, right? Happens everywhere. Phoenix, Brooklyn, even out here in the Midwest. Affordability pressure looks different, but rental demand just keeps going. If these FHA loans actually start working for more types of projects, we could finally trim the shortage. Not solve it, but at least get a jump on it.
It's not going to be instant. But yeah, with more accessible financing, at least the pipeline is unclogged. We'll have to see if developers use this window to move forward, and whether renters see relief in actual new units, not just policy headlines. It'll be pretty telling if next year's HUD stats show that 4% number climbing, then you'll know it's working.
For sure, and for all the renters, investors, or builders listening, this is one to watch. And hey, as we've seen in other episodes, like the new home sales surges and fixer-upper frenzy, it's always some combination of policy, price, and market timing that shifts things. We'll keep following the numbers and developers' moves because honestly, this story's just getting started.
Absolutely. And Ruby, hopefully by the time we check in again, we'll have more real-life examples, not just potential. Thanks everyone for joining us today on Nadlan Forum Podcast Daily.
Appreciate you tuning in, Lior, and everyone listening, you too. We'll catch you next episode. Signing off for now.
Bye Ruby, bye everyone. Have a great day.